Hey everyone, welcome back to Corporate Dakota, the place where we unpack the murky world of corporate finance with a bit of a smirk. Today we're diving deep into CONMED Corporation's latest quarterly report, the Form 10Q for the period ending the 30th of September 2025. Get ready for a financial rollercoaster, folks, because CONMED has definitely had an interesting few months. Before we crunch these numbers together, if you love getting crystal clear insights from these filings without the corporate jargon, smash that like button and subscribe. And hey, join our growing community on Discord. The link is in the description below, and we're always having great conversations about these reports. So CONMED is a medical tech company. They make devices and equipment for surgeons. Think of them as a key player in the operating room, providing tools for orthopedic surgery and general surgery. Their report gives us a look into their financial health and how they performed through the third quarter of 2025. Let's jump straight into the moneymaker, the financial statements. First up, we have the income statement. For the 3 months ended the 30th of September 2025, total net sales came in at $337.9 million. That is up from $316.7 million in the same period last year. That is a pretty solid jump of about 6.7% overall. Now, for the first 9 months of 2025, sales hit a cool $1 billion. That's an increase from $961 million a year ago, a 4.2% rise. It sounds good, but let's dig deeper. Here is where things get a little less rosy. The cost of sales significantly increased. In the third quarter, it jumped from $137.7 million last year to $171.8 million this year. That's a big jump of over 24%. For the 9-month period, it rose from $426.4 million to $469.3 million. This ate into their gross profit margins. Gross profit for the third quarter dropped from 56.5% to 49.2%. That is a 7.3 percentage point drop. For the 9 months, margins fell from 55.6% to 53.1%. That 2.5 percentage point drop might not sound huge, but it is a lot of money when you are dealing with $1 billion in sales. And to top it off, selling and administrative expenses also went up quite a bit, especially as a percentage of sales. In the third quarter, these expenses shot up from 31.5% of sales last year to 41.5% this year. For the 9 months, they went from 36% to 42.5%. CONMED mentions this is due to things like advisory services from their former CEO and consulting fees for operational improvements. It seems like they are spending more to try and fix things. All of this increase in costs dramatically impacted their operating income. For the 3 months ended the 30th of September 2025, income from operations was only $11.9 million compared to $65.7 million last year. That's a massive drop of over 80%. For the 9-month period, operating income fell from $147.8 million to $66 million. That is a nearly 55% decrease. It really shows how much those rising costs are hurting their bottom line. So, what does this mean for net income? Well, it also took a hit for the third quarter. Net income was just $2.9 million, a huge drop from $49 million last year. And for the 9 months, net income fell from $98.7 million to $30.3 million. That is a nearly 70% decrease. It looks like this quarter was tough, and the year-to-date performance is also significantly lower than last year. Now, let's look at the balance sheet to see where they stand in terms of assets and liabilities. Their accounts receivable currently stand at $224.9 million, a bit lower than $237.7 million at the end of 2024. Inventories, however, have increased from $346.7 million to $364.4 million. This could be them building up stock to combat supply chain issues, which they mentioned. Goodwill, which represents the excess of the purchase price over the fair value of acquired assets, remains stable at around $806.9 million. This suggests no major acquisitions or impairments in the current period. Total liabilities are sitting at $1.3 billion. This is a slight decrease from the end of 2024. Long-term debt has notably come down from $905 million to $853 million. This is good to see, especially with interest rates being what they are. Shareholders' equity, on the other hand, has increased from $962.7 million to $1 billion. This growth is a positive sign, indicating the company is building value for its owners. Moving on to the cash flow statement, this tells us how cash is moving in and out of the business. For the 9 months ended the 30th of September 2025, net cash provided by operating activities was $124.3 million. This is pretty much flat compared to $123.6 million last year. It's interesting to see that operating cash flow hasn't significantly changed despite the massive drop in net income. This is partly due to a large non Cash gain related to contingent consideration in the prior year, which boosted net income, but did not represent real cash flow. Investing activities show a use of cash. They spent $13.8 million on property, plant, and equipment in the 9 months of 2025, up from $9 million in the same period last year. This indicates some investment in their operational capabilities. Financing activities consumed a significant amount of cash, with $98.5 million used in the 9 months of 2025, compared to $99.9 million in 2024. This was primarily driven by payments on their term loan and contingent consideration payments related to acquisitions, like Biorez. They had no net borrowings on their revolving line of credit this year, compared to some borrowing last year. COM uses derivative instruments to manage financial risks like foreign currency fluctuations. They've been using forward contracts for cash flow hedging. The fair value of these contracts has been recorded on their balance sheet, with some impacting other current liabilities and others long-term liabilities. It is a way they try to protect themselves from market volatility. When CONMED acquires companies, they record goodwill. Their goodwill is stable, around $805 million. Their intangible assets like customer relationships and trademarks are also substantial, totaling over $1 billion before accumulated amortization. Amortization expense on these intangibles is over $26 million for the 9-month period. This shows the long-term value they place on these acquired assets. Let's talk about debt. Their total long-term debt is $853 million. The biggest chunk of this is the 2.250% convertible notes, due in 2027, totaling almost $800 million. They also recently restructured their senior credit agreement, adding a term loan of $60 million. While their debt is substantial, it has decreased from the previous year. The interest expense has also gone down, which is a good sign given current interest rate environments. Now for the management's discussion and analysis, where the company explains its financial results. They are facing higher manufacturing and operating costs due to inflation and supply chain issues. They've even brought in consultants to help improve their supply chain and manufacturing. They also note that tariffs are impacting their business. It sounds like they are in a bit of a squeeze right now, with costs rising and sales experiencing pressure. The company highlights sales growth in both orthopedic and general surgery. Orthopedic surgery sales increased about 5.9% in the third quarter and 3% for the 9 months. General surgery saw even stronger growth, up 7.3% in the third quarter and 5.1% for the 9 months. But remember that gross margin shrinking we talked about. That offset a lot of that sales growth. They explicitly state that they incurred costs for consultants and wrote off $19.7 million in inventory equipment and patents due to cancelled product lines and discontinued items in the 9 months of 2025. This is a direct hit to their profitability and shows some challenges in their product development or manufacturing strategy execution. Management also points to those increased selling and administrative expenses as a major factor, linking it to those advisory services and operational optimization consulting fees. It's clear they are investing more to try and turn things around. Looking at the overall picture, while net sales are growing, the significant increase in costs, particularly cost of sales and selling and administrative expenses, have severely impacted profitability. The comparison of net income for the 9 months ending the 30th of September 2025 at $30.3 million versus $98.7 million in the prior year is stark. This is a nearly 70% drop, and that is the core story here: reduced profitability, despite sales growth. CONMED also has legal matters to report on. They voluntarily disclosed potential issues with royalty payments to surgeons to the Department of Justice. Fortunately, the DOJ decided not to prosecute, which is a significant relief. They are also dealing with a medical device tax in Italy, which they've been fighting. And while the tax was ruled constitutional, they received a substantial discount on the amounts owed. These legal and regulatory issues can always be a source of risk and unexpected costs for companies. One interesting point is their capital allocation strategy. They've authorized a new $150 million share repurchase program. They also state that they have suspended dividend payments indefinitely. This suggests a strong focus on returning capital to shareholders through buybacks, potentially signaling confidence in future earnings or a strategic shift away from dividends. So overall, CONMED Corporation is in a bit of a mixed bag situation. On one hand, they are growing their top line, their sales are increasing in both their orthopedic and general surgery segments, which is a positive sign. They also managed to reduce their long-term debt and their equity has grown. They are actively investing in operational improvements and managing market risks. However, the picture is clouded by a significant increase in their cost of sales and operating expenses, which has crushed their profitability and dramatically lowered their net income year over year. They are dealing with challenges in their supply chain, manufacturing, and also some significant product line adjustments leading to write-offs. The company's strategy appears to be focusing on navigating these cost pressures and operational challenges, while also prioritizing shareholder returns through buybacks at the expense of dividends. It's a bold move and signals management's confidence in their ability to improve profitability going forward. The key will be whether their cost-cutting and operational efficiency initiatives can outpace inflation and supply chain disruptions, and whether they can leverage those sales wins into actual profits. Alright, that is our deep dive into CONMED Corporation's latest financial report. What do you think about their performance and their strategy moving forward? Are the cost issues temporary or a sign of deeper problems? Let me know your thoughts in the comments below. If you found this breakdown valuable, please give this video a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description where we break down these reports and so much more. Thanks for watching Corporate Decoder, and we'll see you in the next video.